Let's talk about the cost of capital. This is the first of three parts that have to do with the capital budgeting process. We have to know what our capital costs. We have to know how to evaluate proposed capital budgeting projects using net present value, internal rate of return, modified internal rate of return, to name just a few. Those topics will be covered in Chapter 10. And we have to know what the cash flows are that are going to be considered in the capital budgeting evaluation process. So our first step is to figure out what the required rate of return is for a capital budgeting project. So what are some factors that affect the cost of capital? Well, we have general economic conditions. If the economy is booming, interest rates are going to be high and all sources of capital will cost more. If the economy is very soft, this will lead to an environment of low interest rates and a lower overall cost of capital. What about the market conditions that affect our risk premiums? How much of a premium do investors in equity require relative to the return required by investors in debt instruments? Let's call them bonds. And we know that a stock investor is taking a greater risk than a bond investor. So for a given firm, the cost of equity is always going to be higher than the cost of debt. And the amount of that premium that investors require for taking the greater risk associated with an equity investment varies. What about the operating decisions of the firm? What kind of business risk does this firm have? We're talking about the top half of the income statement here, from sales to operating income, also known as earnings before interest and tax. This is the risk that is associated with the kind of business that this particular firm decided to go into. What about the financial decisions of the firm? This is the bottom part of the income statement. Did the firm load up its balance sheet with a lot of debt? This creates financial risk and increases the overall riskiness of the firm. If the firm is more conservatively financed using lots of equity and very little debt, then the amount of financial risk will be small. What's the amount of the financing? If you want to raise a large amount of money, you're probably going to have to hire an investment banking firm. You're going to have to pay underwriting fees and attorney fees and accountant's fees. And you don't have all those additional costs necessarily if you have a small amount of money to raise and you just walk into a bank and get a bank loan. So we want to be able to compute the cost of each source of capital. We want to look at the percentage of each of those sources in the optimal capital structure, and we want to know what the weighted average cost of capital is. So let's start out with a company that finds that its borrowing cost with respect to debt, that is bonds, is 10%. That is, it has to pay 10% interest to successfully sell those bonds. That's sort of our starting point for the cost of debt. Our next step is to recognize that the interest payments associated with those bonds is tax deductible. So the true cost of debt to the firm is lower. That is, the after-tax cost is lower than the before-tax cost. So if you had a company that had a marginal tax rate of 40%, then that 10% would be multiplied by 1 minus 0.4, 0.4 being the decimal expression of 40%, and that would give us a 6% after-tax cost of debt. So in effect, the government is subsidizing us when we use debt capital. If you had preferred stock, we would have a cost associated with that. The preferred stockholders are paid after the bondholders are, so their required rate of return is going to be greater. The preferred stockholders are paid before the common stockholders, so the preferred stockholders are going to have a lower required rate of return than the common stockholders do. So if we had a company that could issue new preferred stock at $42 per share, and that preferred stock promises a $5 annual dividend forever, because preferred stock has an infinite maturity, we would have a cost of preferred stock of 11.9%. Simply the dividend over the net market price. The net market price is the price that the investor paid minus any flotation costs that you had to pay to the investment banking firm, because the flotation costs eat up part of the proceeds to the company that is issuing that preferred stock. Now, when we move to common equity, we're talking about the owners of the firm here. We have a cost associated with that kind of financing, and there are two different types of equity financing. We have internal common equity, which comes from retaining earnings, and we have external common equity, which comes from selling new common stock in the primary market. So the cost of the internal equity is estimated by asking the question, what could stockholders earn if they were to receive all the earnings of the firm? That is, if the company paid out all of its profit as a dividend, the stockholders could invest that money, and the question comes up, what rate of return could those stockholders earn on those funds in investments of the same risk? And so the company in question needs to earn at least that rate of return in order to justify retaining the earnings instead of paying them out as a dividend. So the cost of internal equity is an opportunity cost. That is, it's the rate of return that the common stockholders could have earned if they had been given the opportunity to invest those funds themselves in something of the same risk. Now we have two popular models that we use to estimate the cost of common equity. One is the dividend growth model, and the other is the capital asset pricing model. So with regard to the dividend growth model, we have an equation here that's in your textbook. The required rate of return on a particular common stock investment, K subscript S, is equal to the dividend at the end of the first period. This is almost always a year, so let's just call it a year. The dividend to be paid to stockholders 1 year from now, divided by the price right now, P subscript 0, plus G, the growth rate of the dividends. So if we had a stock selling for $60 a share, and the dividend just paid was $3, and the expected growth rate is 10%, we would end up with a required rate of return on the common stock of 15.5%. Note this adjustment right here. We took the $3, which was the dividend just paid, and we multiplied by 1.10. This causes the $3 to grow by 10% from $3 to $3.30, which is our numerator, and we divide by 60 and we add 0.10. The reason for that is that the model asks us for D sub 1, and the dividend just paid is D subscript 0. So we have to make this adjustment when we're given the dividend just paid. If we were given directly the dividend 1 year from now, we wouldn't have to make an adjustment like this. Now, the capital asset pricing model, which we saw in Chapter 7, is coming back again in the context of the cost of capital chapter. So here is that equation for the CAPM from Chapter 7. Required rate of return on the company's stock is equal to the risk-free rate, which is the rate we could earn on Treasury securities if we were to look for something with essentially no risk to put our money in. Then we add a risk premium, and the risk premium is the return of the market minus the risk-free rate times beta. And so in this particular case, the risk-free rate is given as 5%. The expected return of the market is 13%. And so 13% minus 5% is 8% times the beta of 1.2 plus that 5% risk-free rate. And we get 14.6% as the estimate of our required rate of return on the company's common stock using the capital asset pricing model. Now note that this is an estimate, okay? This is not a directly observable number. We don't know for sure what the required rate of return of those equity investors is, so we're trying to estimate it. Now, if we're talking about new common stock going into the primary market to issue new stock, we have to make an adjustment here. We have to take the market price that the investors are willing to pay and subtract those flotation costs that are associated with what the investment bankers are going to charge us. So what you can see is that the cost of new common stock, K subscript N, is a little bit higher than the return required on retained earnings because we have flotation costs associated with new common stock. We do not have flotation costs associated with retained earnings. So anytime you make the denominator smaller, which is what we're doing when we subtract F here, we're making the overall number larger. So that's why this number is bumped up to 16.25% compared to the 15.5% that we had for the internal common equity, the equity that came from retaining earnings. So here you have a picture of the different sources of capital and their cost. And we're now ready to compute the weighted average cost of capital, K subscript A standing for average. And so you can see that if 40% of our funds are costing us 6% on an after-tax basis, that's our after-tax cost of debt times the weight of debt, and 10% of our funds are costing us 11.9%. This right here is our cost of preferred stock, and half of our funds are costing us 15%. This is our cost of equity. Then on average, our funds are costing us 11.09%. If, on the other hand, the equity portion is coming from new common stock, then this number becomes 16.25%, and our weighted average cost of capital is 11.72%. Now, the cost of capital may vary depending on how much capital you need to raise, and so we're going to look at that issue next. So let's assume that Gallagher Corporation has $100,000 of new retained earnings with which to finance its capital budget. This is the amount of net income that it decided not to pay out as a dividend. So when do we run out of this $100,000 of internal common equity? So what we can do is we can calculate that point in which the weighted average cost of capital jumps because we've run out of internal equity and we're now going to have to turn to the more costly external equity. And so that break point is the available retained earnings over the percent of the total that comes from equity. So that's 200,000. So what you can see here is that once we've raised $200,000, half of which is coming from equity, we will have used up the entire $100,000 worth of internal equity that was available. So the weighted average cost of capital was 11.09% until we raised $200,000 of total funding. And beyond that, we have the higher weighted average cost of capital of 11.72% because of those flotation costs. Now we can look at how that marginal cost of capital schedule relates to the different projects that we're contemplating. We've ranked these from best to worst with regard to the internal rate of return. You don't need to know what IRR is exactly right now. We're going to look at that in Chapter 10 in more detail, but I think it's pretty straightforward to suggest that there is a rate of return that we could ascribe to a given project. 12.4% for Project 1, 12.1% for Project 2, 11.5% for Project 3, and so the height of each of these bars tells us what that internal rate of return is. The width of each of these bars tells us the dollar cost of that particular project. And now we superimpose the marginal cost of capital schedule. And what you can see is that if we accept the highest return projects first and the lowest return projects last, and if we use our lower cost funds first before we use our higher cost funds, that Project 1 is being financed with funds costing us 11.09% and 12.4% is clearly greater than the cost of the funds. So Project 1 is clearly a good project. Project number 2 is financed partially with funds costing 11.09% and partially with funds costing 11.72%. And since it has an internal rate of return of 12.1%, we can see that it is clearly a good project as well. Project number 3 is financed entirely with funds costing 11.72% because we've used up all the cheaper funds, and its internal rate of return is only 11.5%, so it fails to jump over the hurdle. So project number 3 is a project that we would reject. We don't want to do it. And so that is what we do with regard to projects 1, 2, and 3. And we're ready now to move on to a consideration of the methodologies associated with evaluating a proposed capital budgeting project. We're going to look at how to compute this IRR and its cousin, the modified internal rate of return, and the net present value.